On the people side of things, like single points of failure is a classic one. So,
in our business, for the most part.
Yeah, like only John knows how this module works in the software, and nobody else can literally touch it because he wrote it, he maintained it, he's been here for 25 years, he's physically boxed people out from touching it.
And that's where we used to go during diligence. So does John skydive or swim with sharks or anything we need to know about? Does he have a gambling problem that we have to worry about?
It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat.
Welcome back, Paul Stancic.
Welcome back to you.
No, welcome back to you.
Welcome
and don't you go
us.
changing.
Welcome back to us together.
So I think we talked last time about what you do when you finally own a company. You drove the car off the lot.
Correct.
And it's all about value creation. And so today I thought we would talk a little bit about what value creation actually means,
Most
Paul.
overused, misdefined words in private equity. Let's talk about it.
Oh, 100%. So first of all, should we bring out the value creation Bible? Because, every private equity firm is a giant Bible of their playbooks,
It's leather bound.
It's leather bound.
At least 700 pages.
It's in a gold casing that associates are not allowed to touch it. It's like Nigel Tufnell. Don't even look at it. It's still got the old tagger on it.
It doesn't actually exist.
It doesn't
it's a big
exist.
secret.
Because we know what it really is. And what is it? What is the big book for private equity?
It's really more of a Cheesecake Factory menu than it is a book.
Exactly. A very underrated American restaurant. If you have people with very different tastes in food, they could all find something they like at the Cheesecake Factory.
They'll get their Michelin star someday.
100%. If you want an omelet and chicken fingers, by God, you can get it at the good old Cheesecake Factory. So value creation. At its simplest level, right? It's the company's worth more when you're selling it than when you paid for it. But it's kind of a complex formula because you've also got transaction costs. You're hiring bankers to sell it. So it's more like a house, right? You're paying your real estate agent. There's going to be some taxes. And then you've got some guaranteed return that your investors are expecting you to return on that deal. So you got to make 2 times your money or 1.5 times your money or whatever your target is, there's going to be some target on it. So that at the end of the day, that's what you're really trying to do. With all of this being said and done, we're trying to return more money to our investors.
Yeah.
Is that the fair, simplest definition of value creation?
Absolutely. Like the goal is for this to be more at the end than at the beginning. And the reason we call it the Cheesecake Factory, maybe we should say that, the Cheesecake Factory menu is there's a lot of different ways to get to that end state. And if you think that it's the same approach for every company every time, you're either investing in something that's way more consistent than we are, or you're kidding yourself. And I think it's the latter in most cases.
There are some exceptions, I'm sure, very narrow, focused, niche kind of businesses where that's probably possible. But in general private equity, I would say that's not true. Like it's impossible to basically have one playbook that you're following through. Although we'll talk about the cases where it's probably closer to that than it is for us. But certainly with us, it's a Cheesecake Factory because it's a lot of possibilities, but the specific ones we pick are going to fit the situation.
Yeah. And so we've got a whole workshop on YouTube that hits mainly on that point and gets into when we talk about the it depends school of value creation, which we are both very much disciples of. Like, what does that mean? How do you know which parts of the menu to play with? How do you know which parts of the menu you can ignore? And the fact that there is a little bit of an art to this, to sequencing and picking the plays and like the value creation initiatives that you choose to work on with any given company. It's not the same company by company.
No, it's not. And the items on the Cheesecake Factory menu aren't the same, right? I mean, at one point we might have been saying, hey, mobile is a big thing. We buy software companies and they have to have a mobile solution. That's kind of been decided, right? That may be still in the book, but it isn't like the panic that it was. Now, I would say currently the panic would be, let's get AI in everything, right? That new things come onto the playbook and part of our job is to figure out whether it's something worth doing or it's just marketecture. But you got to throw it on there, but it doesn't really mean anything, 100%. Right? So I think Devin's always fond of saying it. I like this. Don't buy a company that you don't know how to sell.
So what does that mean?
Well, so as soon as you purchase a company, at the end of the day, unless you're going to hold it forever, like Constellation Software, they're going to hold it forever and just pay dividends out of the cash flow of the business, you got to sell it, right? So who's going to buy it, right? And while Jonathan Tull's in our favorite movie says we are selling at the market clearing price to willing buyers, we all know that the buyers in each market, they have criteria that they're facing. So if you don't know how to position your company over your whole period, so who's going to buy it? You could end up with an asset nobody wants, even if it's a good business.
Yeah, who's going to buy it and why are they going to say no? I'd say some of the most useful exercises that we've done as a team over the last couple of years are printing out materials that either advisors of ours or other private equity firms that have evaluated our companies have shared with us, because it's a window into how the buyer thinks.
Yep.
And if you pattern match things across companies, across industries, and across those processes, you start to notice there's a couple reasons that people pass. And so if you start to think about value creation as insurance against those no's, that's kind of an interesting way to think about it. But it all comes back to like the couple of categories that we talked about in an episode not too long ago about what do you do once you own the business. Like typically we're doing different things, but they tend to be in the categories of sales and marketing, product and engineering, finance and M&A, and then around all of that, it's people and talent, right? And so during the course of a hold, and probably during the course of a first year of the investment, we are going to be doing stuff in each of those buckets, but it's different every single company, every single time.
Right, because at the end of the day, in our market, this will vary about this, but you could probably put most things in these three broad categories, right? If you're a private equity firm and you buy a company, who's going to buy it? Another bigger private equity firm or coalition of private equity firms, a strategic, meaning, your biggest competitor or, Microsoft or Google or whatever the gorillas are in your category could be buying you, right? Or you could be doing an IPO. Now, in our end of the market, very rare that we'd be doing an IPO. We're typically selling to another PE firm or to a strategic. And as Devin is also fond of saying, we try and get in the way of the strategic. So the easier thing is just to buy us. Right? So the funny part for us is if you're doing it right, the day after you close, it's like the old joke about a boat. What's the favorite day 2 days in a boat owner's life? The day they buy and the day they sell.
Correct.
Theoretically, the day after we've closed, we should be thinking about what we need to do to get it to the end state for the buyer.
Yeah.
Because one of the things we don't control the end market. And so to Howard Marks, we don't want to be a forced buyer or a seller. And then if 6 months from now, we're in a hot market we may start getting offers, and those offers will be, contingent on what we've done with the business in some cases, right?
Yeah. And whether those offers or, if you're running a process and you're intentionally taking a company to market,
which you probably wouldn't do in the first year,
correct.
Right?
But if it's later in the hold and you're intentionally taking it to market, or if you start to get offers, the intensity of that interest is going to be a function of two things, I think. So check me on this if you agree. One, it's the financial profile of the company. Yeah. So it's what the valuation is going to depend on. And we'll talk about what that is in a second, because it's basically two factors. And two, I think it's the clarity of the story, which is really about the clarity of the data. Yeah. Not only can you tell a story about how the business is performing and how clean the operations of that business is, but like, okay, what now for the next buyer? Like, how much juice is there left to squeeze? What does the end market look like? What are the growth pathways that we haven't tapped into yet, but are so obvious because we're going to lay them out that way? Both of those things can matter, and people can say yes or no to a company for either of those reasons. Sure. Yes, for the financial profile, but also if there's a lack of clarity in the story, that makes it a harder yes for someone who might be looking at 4 or 5 deals at one time. Yeah,
I mean, I think clarity of the story may actually be ultimately more important, right? Because, I mean, a bad graphic example, but, you could have a great, super profitable business clubbing baby seals that nobody wants to own, right? I mean, it's highly profitable, but nobody wants to own it.
Not part of our investment mandate.
It is certainly not, only software companies. But we would buy a company that tracks those kind of things. At any rate, I think that's why it's important to be clear about who's going to buy it and why they would likely buy it. Yep. Right. And that's how you keep a hold of the market. So let's talk about what creates value, right? And the first, and I think the easiest thing that if this happened all the time, you and I would be, probably serving coffee you would probably go over to the fancy coffee shop. I would be going to Starbucks or Dunkin' Donuts, but you'd probably be working at La Colombe or something.
Or Sawada.
Of course, yes.
Shout out to Sawada.
The first and easiest is multiple expansion. So if you happen to buy a company that happens to be in a market that's super hot, then, you bought something for 5 times either revenue or EBITDA. And let's talk about that for a minute, but you bought it for some multiple of revenue or EBITDA. Yep. And let's say it's 5. And 2 years later, the market is saying, based on public comps and other private companies, is worth 7 times. You did great. Unless, of course, revenue went down, EBITDA went down the whole time. But if you've sort of kept on plan you're going to make more money just because people are paying more for the business, you paid for at a lower rate.
So this is a weird one. Like, why do multiples expand? Because some of it's in your control and some of it's not. And it can be both good luck or bad luck, depending on where it goes. But like when you think about multiple expansion, why does that happen?
I think you got to think of it in terms of economics. It's supply and demand. So when you're a hot market, the prices go up because there's only scarce assets and more people want to buy them. So in the software business, when mobile came out, people were chasing a lot of mobile apps. Now they're chasing a lot of AI apps, particularly in the venture marketplace, because it's a hot market and there are fewer commodities, which bids prices up. That's just reality.
Yeah, and there's good data out there. Like we like KeyBank's SaaS survey every year.
Yeah.
They put out good data on there. But if you look at the line chart of the average multiple paid, now you got to parse that data by, is it VC or growth equity or guys that look like us? But the average multiple paid for a SaaS business in like 2021 was what, like 9 or 10 times on stuff that transacted, and it isn't that anymore. And it's because of that more economic reason.
But you don't control that.
100%.
Right.
100%.
So you could do everything right. And if you bought at the wrong multiple, you could still lose your investment.
Yeah.
I mean, that's the reality.
Yeah.
So you have to be very careful of this going into it. So it's an easy way to make money if you just hold on for the ride, right, in the right market. But it's also an easy way to lose everything if you find yourself in a market that's no longer interesting and you overpaid.
Yeah. But there are times where multiple expansion can be a reward for overall quality of the business too, right? Like we've seen situations where you might be buying something that you could define as subscale, which means it's below some level that an investor or somebody else would evaluate like, hey, that's not for us. You hold on to it for a few years, you grow it, maybe you do some M&A, and all of a sudden a business that you bought that was $4 or $5 million is now 10 or 20 million bucks. And because that is perceived as more stable or a platform that you can build on, maybe someone's going to reward you with 1 or 2 more turns of a multiple on it. So that's one way that it happens.
I mean, I typically see it on software deals. We'll see it, they're going to try and clip your wings for those things. So it's more around, we see that more in risk and then pulling, a turn away from,
Sure.
So let's say, hey, your cyber security isn't great, or you got a lot of tech debt. They're going to try and, eat into the price using those.
Well, that's
in our market.
That's interesting. Like, what are other ways that people would get penalized on the multiple side of things? Because those are 2 good ones. I can think of a couple from my world, but what else would pop up in product and engineering?
Well, product and engineering, they'll hit you on everything. Cyber is the easiest because everybody understands how important it is, right? So it's the easiest one to sort of have a black or white. We use this third-party firm. They ran some scans. They didn't like this. Now, the details of it are much more complex because you'll see, and we've talked about this in the cybersecurity episodes we've done. It's very complicated, but that's one of the places opinion because it's relatively easy and they can use a third party to do it. And they say, hey, it's not me, Paul. It's the guys at CyberZone. They say you're not up to speed.
CyberZone.
You can get it from the quality of your tech debt. So you may have your third-party diligence firm may say, hey, using an old version of this operating system or this database or this language that creates some risk. And so they'll try and ding you on that. Or sometimes they can really tie it to a particular technology. So they might say, well, and we've seen this in deals, you're currently selling enterprise on-prem license and you're in the process of turning into a SaaS platform where you're sort of charging annually or monthly. You could be in that transition in the middle of this thing. And so you're getting dinged for selling enterprise. You'll get rewarded if you get it all the way through, but they may ding you that, oh, hey, we were kind of hoping you were at 60% SaaS, not 20, right?
Yep. That's
now
right.
On your side, you get dinged a lot on your side. That's an easy one to ding people on.
Yeah. And sometimes people kind of invent reasons just to say no because like, we don't love this, and that can show up in different ways, but some concrete things that can hurt you. Like one, you talked about end market. So if somebody else just doesn't get the end market, or if the competitive dynamic in the end market doesn't look good for you, like maybe there's a bunch of stuff in your data that says you keep losing to these competitors, and your position is just weaker than it was 4 or 5 years ago, that doesn't look good. And that's a reason for someone to say no, or for you to get hurt on the multiple. Your mix of growth is a big one.
Yeah.
So one of the first things that we do when we start tracking data on the go-to-market side is we want to see pipeline and bookings, not just aggregated, but in terms of new logo and upsell or cross-sell. Because one of the most common things that you get hurt on in an exit process is your growth looks good, but how much of it is new logo versus how much of it is just squeezing the existing customer base, because eventually that squeeze gets harder and harder and the juice runs out.
But that's complicated though too, because you take a manufacturer, right? That if the overall market is growing, they might not care, right? Because
Totally.
in fact, you're just taking a share from existing customers and those customers are growing like mad. This is a complex issue, right?
Totally. And it's a bit of a cross between,
It's subjective, objective arguing.
and there's an interaction between the health of the market and the mix of your growth.
Yes.
Like people might not care. There's probably not a lot of questions being asked right now with AI companies. How much of your growth is new logo versus upsell? Because we're in the middle of a bonanza right now. It may be less relevant of a question because almost definitionally, everyone's adopting AI for the first time. And so your mix might be mostly or all new logo if you're a new product. For an established company, we've seen it work for and against us, where if we manage to get new logo growth growing, you get some bonus points for it. And if you're getting fat and happy off the customer base, but you haven't cracked the problem getting yourself to introduce to new customers, that can hurt you in an exit process. So I'd say those are probably the two most common, but what does a buyer want to see and what would they reward you with from a multiple perspective? They want to see that you're in an end market that they like, that they can see themselves spending 4 or 5 years in, because that's what a private equity investment means. They want to know that there's a lot more customers out there to go get.
Sure.
Or existing customers that you can do more for. And they want to see that that's repeatable and that it's an engine that they can put money into, not something they have to figure it out. They want it to be a scale it up problem, not a figure it out problem. So if you can prove,
ideally, right?
Yeah. So if you can prove that that's the case, and to your point, back to the point about value creation, if you can start with the end in mind and think about that exit process in 3, 4, 5 years and say, these are the questions that we know we're going to get. These are the things that we know we're going to have to prove. Let's just start working on that stuff right now.
Yes. Right. So I think going into this, as we talk about, multiple expansion and returns, the deal teams and the market tells you whether your sector of the market is evaluated by revenue multiples or EBITDA multiples.
Yep.
Because technically it's just math. If you have any EBITDA, you can calculate the EBITDA multiple.
Fact.
When you have any revenue, you can calculate the multiple. But that does the market tells you, hey, we buy these kinds of businesses. Like manufacturing businesses are largely bought on EBITDA for the most part, right? Unless it's like advanced super electronics or something. And a lot of software companies are built on, particularly in the early goings, when there's a market wave going on, they're purchased on multiples of revenue because they assume that if they can get enough customers in a cool market, eventually they'll be able to farm those customers for a lot of good EBITDA.
And the company has intentionally chosen to take fewer profits to reinvest in growth in most cases. So it's
if they are reinvesting in growth. So it's I would say reinvesting in smart growth. Doesn't mean you don't play some bets that don't work out, right? But you just don't. I mean, I think what would case number one for this might be the metaverse. Billions of dollars that went in the metaverse.
It's going to be big someday, dude. You got to believe.
All right. So besides multiple expansion, which would make our lives really easy at first, and then they would just get rid of us because what they need us for with multiple expansion, right?
Yep.
Let's talk about how you can add value, air quotes. So the first is increase revenue.
Yep.
So why don't you talk about that first, because that's kind of your baby, right?
Yeah. And there's only a couple ways to do it, right? We've talked about a few of them. It's basically you have existing customers. Most of the businesses that we buy, that we get excited about, part of the reason that we get excited is there's a lot more that we could be doing for our existing customers.
Yep.
And most of the software companies that we buy typically have more than one product. And if you went and talked to an average customer, which by the way is something we try to do during diligence, and you ask them, what else could this company be doing for you? They have no idea. No. And so one of the easiest things that we do early on as a value creation initiative is to try to figure out how to solve that problem and simply communicate to customers what else is on the menu. And don't even try to sell them. Just say, I put it in a format that I call the apologist pitch, which if you're the customer sounds like, hey, our bad. We had a meeting as a leadership team the other day and we realized we've done a really poor job of communicating everything that's on the menu and all the ways that we can help. And I have no assumptions that we're going to solve that problem for you today and you're going to buy something, but I want to fix that. Sure. And all I want to do is share something with you that explains that so that when these things happen, you know to call us. Can we just do that? And what we found is, one, customers typically say some version of,
I didn't know you had this.
I didn't know you had that, and thank you for telling me.
Yes.
Right?
Yep.
So it's not going to upset your customers.
Yep.
They actually view it as a value add thing, back to value creation. And if the company commits to that, which typically involves the CEO being a part of it,
Yep.
especially in smaller businesses, deals fall out of
Yep.
that work.
Yes.
And so in a situation where most of the time we're trying to kickstart growth a little bit, and part of our underwriting is, hey, we might be growing in single digits and take that to double digits. Nothing crazy. We're not venture capitalists, but we do want to accelerate growth. That is the number one thing that we do with almost every business, is figure out, first of all, what's on the menu. And sometimes that's a big discussion of how many products do we actually have, because you ask different people and it's a different answer. But once you know that, go talk to your customer base, who probably hasn't heard from you in a while, and communicate what's on the menu. Because if you do that, they know to call you, and some of them probably have the problem that you can help them with right now.
Sure. So, in this category as operating partners, we get involved in everything from buying or building new modules, changing packaging or changing pricing, updating the territory, signing channel partners. I mean, and we're going to talk about this in some future episodes, all the detailed ways you can do that, but loads of paths to increase revenue, right? In some cases, if you're in a market that's being paid for a revenue multiple, you'll reinvest the EBITDA from those things into keeping that growth going. So we've owned businesses that started in the teens of revenue and $5 million of EBITDA, and they were in the 50s of revenue and still $5 million of EBITDA 5 years later, because we were pouring the extra profits into growing the business. And again, if that's what you're going to get rewarded for in your market, that's what you should do. In markets that are smaller, like, for example, School Messenger, which was K-12 notifications, I mean, the whole market was like a $300 million market. So you got to be super careful how much you spend, because if every student in the entire United States was a customer, you'd still be at $300 million.
Yeah,
so
100%.
you have to be careful.
And so on the revenue side, I'd say that's the number one thing that we do. And if all we did was look for growth in the existing customer base, I've given this speech at a few board meetings, like, guys, you don't need to talk to a new customer all year and you can still hit your number. And we like businesses where that's true. And we don't necessarily endorse that approach, but it's an interesting thought exercise about where the growth would be in the existing customer base. In the best situations, what we're also doing at the same time is making friends with the rest of the market. And solving the new logo issue before it becomes a problem for us. And, the way that we look at part of diligence is, you should figure out what your ideal customer profile is. You should figure out the segment of the market where you just win more. You should build a list of those people, and you should find a way to stay in front of them at least once a month to start. So there's tons of data providers out there. Like, the very natural next step to do after everybody agrees on what the ICP is like, okay, let's go build a list of the 1,000 companies and the 7,000 people that work in there, and start getting in touch with them in a responsible way, ideally where they hang out. Could be email to start.
Could be email. I think that place, the fork in the road for that is, are you in a greenfield market or are you not in a greenfield
So why
market?
does that matter? Talk about that.
So let's talk about, we'll use my favorite fictional example, software for managing dental offices. I don't know why I got this in my head years ago, but it's in my head, right?
You do like that one.
So you got to schedule patients, you got to bill. Every dentist that's in existence has some system, whether it's a pen and paper, spreadsheet, who knows? They got a system. So it's not a greenfield. You're taking away from some solution they already have versus a net new solution. For example, from a gas lawnmower to an electric lawnmower, battery up and electric. That's a very different. It's a greenfield market. Yeah, somebody's already got a mower, but they don't want to be going to the gas station. They want to have gas in their garage. They want to be environmentally conscious. Like, it's a market where somebody doesn't have a solution. The challenge, of course, is way easier to sell into a closed market because they understand what you're selling them. Sometimes it's a religious sale if you're trying to sell them something new that they didn't really know solved their problem.
It's hard in different ways. Like in the market where everyone's got a solution and you're trying to shoulder your way in there, you need a way to figure out, one, like, what are the moments, why you, and more importantly, what are the moments where people get so fed up that they're actually willing to listen to you? Because that's what you should be playing into in your market. And then you hit on it. And if it's truly, somebody using any kind of lawnmower for the first time, to use your metaphor, like, you're going to have to explain to them what this thing is.
Yes.
And why it exists.
Yes.
And why they need one.
Yes.
Like, hey, typically people,
and why they need ours.
Yeah. And typically people, if you're running into XYZ, then you need a schmumble. And we're the best schmumble provider out in the market.
I mean, when you think of schmumble, you think of us.
That's a Dave Kellogg example. Shout out to Dave. But yeah, they're hard in different ways, but it pays to know which one of those you're in. And we've had some really interesting debates in board meetings for hours on that point. Like, are we in a why buy ours or a why buy one market? Because you got to know which one of those is to know what to do on the increased revenue side of the house.
Right. And so the transition between, so the next category down typically is to cut costs, right? But let's tie it to revenue for a second, right? And we've seen this, in a lot of different ways. Jeffrey Moore talks about in Crossing the Chasm, the customers are trying to buy a solution.
Yep.
Not a technology, no matter what it is, right? They're buying a solution to their problem. And if you can't solve it entirely, you partner. And the partner, universe becomes the solution to that customer, right? Now, the more successful you get, you begin engineering out your partners, either acquiring them or building your own and cutting them out. So, for example, we own WorkWave is a great example. They had a third-party geo-locating system that cost them, a few dollars for every sale.
Yep.
They bought another company. They replaced the third-party technology with theirs at a much cheaper price, and basically they cut costs out of their existing solution. So that's when you think about cutting costs in our side in software businesses. Can we engineer our partners such that we're getting margin on something that we used to pay somebody else for? And that's particularly in a case where you've got revenue going up. If at the same time you're able to carve costs out of those new sales, man, you are paying some real dividends, right? Particularly because in software, you get credit for the stuff going backwards. If you're a manufacturer and you start buying, same quality metal for your metal manufacturing business at a cheaper price, fantastic. But it doesn't help the customers who bought it last year.
Right.
But in our case, it does because we're no longer paying those third-party royalties, right? So you can really ramp the increase in revenue and keeping costs relatively flat in the software side of things, which is why cutting costs for us is interesting, right?
Especially if it's cutting costs in the interest of building a more complete and more simple solution at the same time. Because if you're doing M&A, you're tucking things in, you're absorbing that tech stack. You know more about this than me, but you might be running, duplicates in the background. And the real juice is in, getting a more complete solution that does more jobs for the customer, but then consolidating that onto a more efficient, lower cost stack over the course of a couple of years.
Right. And again, that's also part of our job as an operating partner is to know the whole universe. Take BizCom as a great example. Right? They were a fax software business, literally FAX, not FACTS. You'll have to Google that, anybody under a certain age. And they use telecom lines, POTS lines. So they acquired those lines from Verizon. Well, 10, 15 years ago, that was the only way to do it. AT&T, Verizon, your local telco. Amazon came out with a Chime product just as we were acquiring this company, and we had tried it at Contelligent, and that cut, $1 million, $2 million of costs, which were real costs, the lines that went into our system. So sometimes this can be real big savings. Now, I would say where we typically see it is PE funds that do very large buyouts. And they basically look at it as, hey, I can cut a lot of the fat that's been built up in the organization over time. And this is a tricky one because you get a lot of like, oh, that's all PE people do is buy companies and gut them. And that's not the case. I mean, in a lot of cases, this bureaucracy starts to make the company itself not serve its customers very well.
Totally.
You hire a new person for everything, and suddenly every meeting is a committee of 20 people. You can make money on your return simply by simplifying and streamlining those business processes and dividending out the cash or paying down debt. That's a way to get a return. Hard to do in our end of the market because our companies simply just aren't big enough. There is no fat.
Yeah, if you think about a $20 million business that's has $15 to $18 million in operating costs, like the way that I think about it is like you're looking for obvious waste, and if you make the assumption that the obvious waste in that spend, which means you could get the same result or the same customer love with less spend, is, 5 points of your, there's more dollars in a larger company that spends more than in one of ours. And so it's easier to find. But I think,
but it's also, it's easier to find. And I think you'll often find that your customers start becoming happier because the bureaucracy that they dealt with starts to go away in those situations, which is a good thing.
And it goes back to like simplifying the offering.
Yep.
So if you're basically running 5 businesses with 5 different cost structures, your customers are probably having an even harder time getting the complete solution, in the door, or having all of their problems solved. Like some of it's just consolidating things and say, this should actually be one business, not 5 business units. I'd say the other thing that is less people intensive is sometimes there's spend on the customer acquisition side of the business that is just not productive. I mean, we have a very recent example in our portfolio right now where there was millions of dollars of marketing spend, and part of the
literally
thesis,
millions in a relatively small company.
Yeah, and part of the thesis was we believe we can turn this off with relatively no impact to the business. And this gets back to the talent and hiring problem, and we're probably going to have this person on the podcast at some point. But literally half of the final round interview for this marketing leader was giving them real data about our marketing spend and real board slides from the company, and asking them, how would you approach this problem of cutting the waste out of our performance marketing spend? And on that whiteboard over there, we worked out exactly how much we could get out. And it's been amazing. 1, how accurate that exercise was, but 2, how clear it was who the right person we should hire was for that job, when it was a very close 2-horse race before we did that exercise. So it's with larger companies than we invest in, there is more waste, definitionally, because there's more spend. But there is typically...
Call it more friction. I would say more friction, right? Because we're not just cutting people to cut people, right? If the business has high costs, but really great customer service, and the people are stretched, that's not fat. I mean, they're just places where...
Correct.
Somebody hired a team over time, and it just happened, right? The person who hired it may not even be there, and nobody really rationalized the team.
Correct.
So at very large companies, that's possible. It's just friction and overhead, but we don't see it a lot at our end of the marketplace.
No, and there's just not that many people in our businesses. Right. These are 100, 200 person businesses,
and that's most of our costs. To 100%. Be honest, is people almost always in our business.
Walks on 2 legs. That was Bain Partners' favorite saying back in the day. So
anyway, I'm not going to do my Bain impersonation. Oh, maybe I will. All right. So the last category I find is the trickiest, right? So this is reducing risk.
Yep.
Right. This is a tough one because going to your deal partners and saying, hey, the first thing I'm going to do is spend some money because we've got some risk here. Because typically when you've got a risk problem, you're not cutting costs to address risk. You're spending some money. You're replacing somebody, right? But this is the place that's going to trip you up when you sell the business.
Yeah.
So if you're not careful and you don't touch some of these risk factors and you sort of play the odds, hey, we're not going to buy flood insurance because we're not going to get a flood. And if you get a flood, we got trouble, right?
Yeah.
So as an operating partner, we have to be no Chicken Little. We can't say the sky is falling or the boy cried wolf or your favorite metaphor here. We have to be realistic about the chances of something happening. Is it a real risk?
Yeah.
And if it happens, what's it going to do to the business?
Yeah.
Is it going to cripple it or not?
And there's risks in people, and there's risks in processes, and there's risks in technology. Like on the people side of things,
customers, vendors, they all have risks, right?
On the people side of things, like single points of failure is a classic one. So,
in our business, for the most part.
Yeah, like only John knows how this module works in the software, and nobody else can literally touch it because he wrote it, he maintained it, he's been here for 25 years, he's physically boxed people out from touching it.
And that's where we used to go during diligence. So does John skydive or swim with sharks or anything we need to know about? Does he have a gambling problem that we have to worry about? Yeah. But that's, again, so adding a body to mine the stuff out of John's head is just increasing costs in the short term.
Yep.
Right? Now, there are places where we can get paid for it. So like School Message is a great example.
Yep.
There was a large public company that wanted to buy it when we bought it, but they would have killed the patient. It was too small. They had some IP licensing risk. So it was a relatively short hold for us. We only held it for 3 years, but we get paid to clean up the risk. There were no single points of failure. There were no licensing issues. So Wes could feel good about overpaying. And in fact, a lot of times your strategics are happy to overpay if you would just clean up the problems for them because they just don't have the ability to do it themselves without killing the patient. Because they're just too big.
And contracts can be another example. I mean, if you're on short-term contracts or everything's on customer paper, that's, I don't want to say it's an easy one, but that's often an obvious one that we want to look at. almost right away, especially if customers are happy to sign.
Let's not do that, Paul. Let's not do the we when we know it's Cass that has to do that.
Yeah, shout out to Cass.
Yeah, shout out to Cass who's stuck with that. It's like the line of dodgeball. I call him keepies, and he opens up the big closet with the paper in. But that's true. That's very common. Like when we sell a business, we have to have a clean customer database. We have to have clean contracts. Whether you like the terms of the contracts or not, never mind. We at least have scanned copies of the paper. We know what customers signed, and we know when their licenses are due. That's a very common thing for us, right?
Yes.
So those are the things I think we have to be careful about overspending on risk early. Is it really a risk, or are we just panicking a little bit? And we better be damn right when, by the time we go into a sale process, that there are no big risk factors that are going to cause us a half turn or a turn of a multiple.
Yep.
Right? Like somebody, hey, your cyber's terrible. You don't have contracts. So I was going to pay you 6 times, but I'm going to pay you 5.5, right? What's the old Father Guido Sarducci line? So I Presbyterianed them down to 5.5, right? I mean, that's what they're going to do. So, and you're going to know they're going to do it because we would do the same thing, right? And we do it in a very, if I'm cutting, if we're buying a business and I'm saying I got to carve, $500,000 or $1 million out of this deal because you got a cyber problem, hopefully I'm spending it on the cyber problem, right? That's the reason I'm doing it, right? So in most cases, these things can be somewhat hard to argue if they're concerned about the risk and you haven't done anything about it.
Yeah, and just a disclaimer for the investors that are listening out there, one of the most helpful exercises we've ever done as a joint deal and operations team is literally take other private equity funds' diligence memos that they've shared with us, because it's all the questions that they want to cover in diligence.
Yep.
And after the deal is done, whether it went through or not, we print out those memos. We sat in that conference room right over there, got coffee for everybody so we were good and caffeinated, and we literally flipped through all of the decks and tried to figure out what are the questions that seem to come up again and again and again. And if you do that for a couple hours and you stay caffeinated enough, you start to notice that there are 5 or 6 categories of questions that get asked every single time, not only about risk, but about data quality, and so they're different for every market. In software, cyber comes up every single time. That would be one that gets on the
cyber's
list.
going to come up in every single business because it's super easy, right? If I'm buying a manufacturer, it's an easy thing for me to say I'm not comfortable with your cybersecurity, posturing or positioning. It's just an easy thing to do. You can get a third party to be your bad guy. I'd do it too, right? And there's no value in taking a risk on cyber.
Yeah.
You don't want to be on the front page of anything.
No, but it's the same stuff that comes up every single time that you need to start addressing right away. It's customer concentration. It's the contracts. It's cyber. So it pays to know and to have a very concrete perspective on what those things are, the risks that come up, but also the questions that investors are going to ask. Because I think another source of risk is having incomplete or unprepared answers to those questions when you find yourself in an exit process. And a lot of this is around data, customer data.
Yes.
Like, is your customer data clean? If somebody said, I'm very interested in buying this out of the blue, could you send them a customer cube? Like who your customers are, what they bought, and how long they've been around. And that simple question, anybody who's worked inside of any kind of business knows, it sounds simple, but in a lot of cases, it's really messy. You're stitching together data sources.
Does it match the financial statements?
100%.
I mean, you have all those issues, right?
Yeah. And so the thing that we push early, because we've seen that happen so many times, is we got to get to a clean customer queue. Because when you start to think about exit readiness, we'll do another episode on that whole topic because it's worth its own discussion. But I would say the number one thing when it comes to exit readiness and thinking about that as a risk is, do you have clean customer data that is easy to share and easy to understand? Because if you don't, that's a risk to an exit.
Yeah. So I'm going to say boldly, where no PE man has gone before.
Okay, let's go.
That's number one in any exit, because it's the first thing they're going to ask you.
Yes.
They're not going to ask you, hey, what are you using for source code control? They're going to say, who are your customers? What have they bought? How long have they been with you? It's going to be the very first thing. And if you can't do the bam right in front of them, I will get you next week. You're already going to start to create a little bit. How do they not know what their customers are? Even people in our business who own portfolio companies that don't have a good customer database will ding us when they try and buy something for not having a good customer database.
Yeah. And what's the old phrase? You only get one chance to make a first impression. Often the first impression you are making is that ask.
Yes, 100%.
Show us your customer data.
Yes.
And the minute they ask you that, the investors are starting their watch and paying attention to how long it takes you to respond to that request.
Yes.
And if it's days, you look really good. And if it's weeks, you don't look so good.
Right.
And they start to ask questions about what else is going on here and what other logs should we turn over. So yeah.
In the best case, it's like, Devin on BizCom. Second later, the fax machine's going on behind him. That's the customer database coming through to you right there, my friend.
Exactly.
But yeah,
exactly.
But I think that is a very, very important point as you get into a sale process. The more you know about that as early in the process as you can, because you're going to get people who start sniffing around your deal 6 months after you bought it. And the better that answer is, the easier the rest of it is going to go, in my opinion.
Yeah, and I would say, we're tying this back to the topic of value creation. In my world, which touches sales and marketing and customer success, kind of all things customers, the two annoying things that you can do as early as possible in a hold that don't seem like they're making a difference, but set up such a foundation for success. One is build a list of your ideal customer profile prospects out there. Yeah. Because when you have that,
and we're going to do an episode on that, because
we absolutely will. But like that last mile of actually agreeing on what the ICP is and building the list is annoying work. It's data intensive spreadsheet work. But if you finish it, it's a competitive advantage that a lot of companies won't get to. And the other thing is what we just talked about. It's having a clean customer file where you can say, we have 3 or 4 or 5 products, not 57 and a half products. This is who the customers are. This is how much they pay us. And this is what they buy and don't buy. If you have that, and you get to that in the first year of an investment, you are ahead of the vast majority of companies out there.
To any degree that you can basically do an append to that data with any of the business demographics. So if you're selling into multiple market segments, what segment they're in, what subsegment they're in.
What's the NICE code? What's the population size? What's the revenue?
The better answers you have to that, first of all, it's going to make life miserable for the PE associate who's buying your company, because they're going to be going through those cubes, Have you done a Monte Carlo analysis
buddy.
on that? Have you done a SPSS run? Have you done a Minitab? Yes. Everybody's a data scientist now.
Yeah.
So we have an episode already out talking about how we engage at this level. So once you've decided what value creation is going to be, how we start to make that process work, which is sort of between our last episode and this one, where you can see actually how we've done it in our market. Yes. But at the end of the day, you only got a few ways to create value in these businesses, and we're not geniuses. The PE people don't have the answer, but we can help you facilitate that process.
Yeah, and it's simple stuff that's hard to execute. But if you spend diligence getting a sense of, is this a business I want to buy, first and foremost?
Yep.
But also, where are the opportunities to create value? If it's revenue, cost, risk, and you come out of that with the CEO agreeing on what you think, I'd say you're in really good shape.
Yeah, I think the one mistake that we would run into here as operating partners is, they involve you in the diligence process. Great.
Yep.
Let's not be too confident in our ability to create value. We got to be looking at this saying, is there really a way to create value in these categories? And if it looks like it's really hard or really risky, deal team needs to know that. Does it mean we wouldn't do it? No, but we may pay a lower price, or we may need to get a much bigger return if we're going to take on that level of risk. So, we are happier when this sounds surprising, but we're happier when we see lots of opportunities, for value creation in these businesses that are not super risky, that are, hey, we just didn't have time to do it. It's like painting the closet or something like.
Yeah, because if there's a bunch, it's easier to sort them into the 3 buckets that matter, I think, which is it a yes, a no, or a too hard?
Yes.
Because it might be a really good opportunity, but if it's going to take up all the oxygen in the room, or you don't have the ability to go capture it, don't go chase it.
Right.
Especially if there's a bunch of other easier low-hanging fruit.
I think we've covered it all, my friends.
We did pretty good. We went off the agenda, which we almost never do.
That's true, actually. He said laughingly. Ciao for now, my friends.
Thanks, everybody.
Neither this podcast nor any of the information contained here constitutes an offer to sell or a solicitation of an offer to buy any security or instrument in, or to participate in, any Parker Gale fund or other investment vehicle. Past performance is not indicative of future results, and there is no assurance that any Parker Gale fund will achieve its objectives or avoid significant losses. This podcast may contain forward-looking statements. Such statements are subject to various risks and uncertainties. Parker Gale is an investment advisor registered with the United States Securities and Exchange Commission. Registration with the SEC does not imply a certain level of skill or training. Guests appearing on the podcast may or may not be a financial sponsor of the podcast or an episode of the podcast. Parker Gale may have business relationships with certain guests, sponsors, or organizations mentioned during the program. In some cases, guests or sponsors may provide services to or receive services from Parker Gale, which creates potential conflicts of interest. Any sponsorship of this podcast does not imply endorsement by Parker Gale and is not provided in exchange for, nor intended to solicit, business between the sponsor and Parker Gale. The appearance of any guest does not constitute an endorsement or testimonial of Parker Gale or any fund. For additional information regarding Parker Gale, please refer to Parker Gale's website, www.parkergale.com, or Form ADV, available at advisorinfo.sec.gov.
From the heart of Chicago to all over the globe, couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a